Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on these financial markets and how the big institutions move the market. It's the big money is what moves the markets, and it's very similar to an auction here. When there's more buyers than sellers, price is going to go up. When there's more sellers than buyers, price has to go down. And that's the same thing, Al, in these other asset classes, the futures market, the Forex market, and even in the options market. Now, I want you to there's a lot of opportunities with these other markets, and I want you to dissect, first off, the futures market. First of all, why is there so much opportunity for the average investor? Because Wall Street and the institutions are utilizing these other asset classes. Why is it such a phenomenal asset class for investors to utilize? And then also, what is the futures market? Like, what is it in general?
Right. And the reason that we have to go into explanations here of these different markets is because Wall Street is not doing that for their clients. And I think the interesting thing, Josh, is that Wall Street puts their own money. And when we're talking about Wall Street, we're talking about, the companies like Goldman Sachs, J.P. Morgan, Merrill Lynch, people like Warren Buffett.
Yep.
Yeah, they put their money in not only in stock, but they put their money in the futures market, in the Forex market, in the options market. But they put their clients' money in mutual funds and annuities. Those are kind of the two big go-to.
That's kind of one of those things, do as I say, not as I do. You've heard that before.
Correct. And people want to know why there's such a difference between the returns that Wall Street gets and they get as, private investors. And that's one of the reasons. These are leveraged assets, the futures market, the Forex market, that's the foreign exchange market and options.
What do you mean by leverage?
By leverage, it's power. It's buying power.
Okay.
It's like having a mortgage on a house. If you want to own a $400,000 house, you take out maybe you put down $20,000 or $30,000, and then you control a $400,000 asset for maybe $20,000-$30,000. That's leverage.
So when institutions are using that, they use much less capital.
Exactly, and that's one of the main reasons to do it. It's used less capital, and it's maximizing the value and the power of every dollar that you have. The futures market, that is where you're really looking at what the value of something is going to be in the future. I guess that's why it's called the futures market.
Pun intended.
Right. And when the markets we're talking about that are part of the futures market are the major stock markets. So if you want to be involved in the Dow or the NASDAQ or the S&P 500, it can be done with futures contracts. What about commodities? Sugar, corn, soybeans. What about oil, gold, silver?
Yeah.
Interest rates, currencies. Those are all part of the futures market.
What I really like about the futures market, Al, is people are, a lot of investors want to be invested in the stock market, but they can still do that within the futures market.
Yes, they can.
Because you have the S&P 500, the Dow, the NASDAQ, the Russell. You have those different things.
They're all accessible through the futures market, again, with that maximum buying power. Futures are open a little over 23 hours a day, almost round the clock opportunities there.
So you're telling me the institutions aren't stuck to that 6.5 hours a day?
They are not. The stock market is, that's a 6.5 hour market, but the futures market and the foreign exchange market also are essentially 24-hour a day trading.
Now think about that. Average investors don't know that's available, but it is. So the public could utilize these other asset classes and trade in the evening.
Correct. You choose when you want to trade, and a lot of people are tied up during the work days. Maybe 8 to 4, 8 to 5, 9 to 5, and having the ability to participate in a market is limited to them. But it's really not if you're using something other than just the stock market. But again, most people are counseled to put their money into something like a mutual fund. And what we find is that most of our students, when they understand really what is involved with mutual funds, that's something they choose not to be involved in unless it's the only thing they have access to in a 401k.
So the futures market is open 24 hours a day.
Correct.
To clarify, it has buying power. So the Wall Street is utilizing less money. Now get into the Forex market.
Correct.
What exactly is the Forex market? We'll call it foreign exchange market.
It is the foreign exchange market. It's a 24-hour market with good leverage, say 50-to-1 leverage, which means every dollar that's invested can control 50 times that amount. That's that buying power that you get. And this is a currency market. You're looking at the difference in exchange rates between two different currencies. And there's a number of different currencies that can be paired together. But typically, there's always something going on in a country somewhere that's impacting its currency.
So it's essentially trading one country, their exchange rate against another one.
Against another one.
So the dollar versus the yen, the euro versus the dollar, the pound versus the dollar, all those different currencies.
Correct.
Okay.
Correct. Yeah, and what we find oftentimes is that one currency is going to be outperforming another during certain situations. So, and who trades the foreign exchange market? Hey, the big institutions do. The big banks do. Corporations are very concerned about that if they're an international company, because the currency, the value of the currencies that they're dealing in the countries they're dealing with is impactful on their bottom line.
Yeah, well, that facilitates international trade and investment.
Correct. And again, 24 hours, great leverage. Getting back to futures again for a minute, if you are a short-term trader, if you're looking for, in other words, if you're looking for a return or a profit potential in a short period of time, it could be on a daily basis or weekly basis. Futures are probably the asset of choice. The foreign exchange market, maybe a few weeks, few days to a few weeks. It can also be used long-term for your retirement accounts.
Now, think about that. When institutions are trading for income, they're utilizing these shorter-term assets. And when they're trading these shorter-term assets, I'm sure they're not sitting at their desk and trading all day long. They're probably setting their entry points, like you said, setting limit orders like you were mentioning in the first segment. But now think about this. Brokers require less money to get into these other asset classes, because we know the stock market, the investors need $25,000 to invest in to trade more than 4 times per week.
Correct.
With these other markets, the brokers require less. So there's a lower entry point for the average investor. And Al, we talk a lot about these different asset classes in these investing classes that we host, and how the institutions are utilizing less capital, how the institutions are being able to participate in 24-hour markets. Well, it's available to the public as well. The public just doesn't know that. Now, Al, there's another asset class called options, and that also has buying power.
Right.
Now, that's utilizing the stock market. Just explain what the options market is. A lot of people have probably heard about it, maybe seen some things on TV, but just don't understand the terminology of it as well.
Right. And most people that have heard about options or know somebody that has traded them, in most cases, they have talked about or heard from somebody who's lost money. And it's because they don't understand that asset. All of these assets we're talking about, futures, forex, options, all have things that are peculiar to them.
That was a word we couldn't say a couple of weeks ago. Let's try it again.
And I've been practicing it, and I don't know why you get stuck on something.
It was
like
a little bit better this week.
Peculiar.
There you go.
But they're to each of these individual assets. So it's part of the education. Some of these things might be appropriate for a person. Some might not be. Maybe futures is great for one person, not for another person. And if you want to have access to education, it should cover all of the different assets, and it should be geared towards you specifically. So it's kind of customized to your particular style, what your risk level is, what your expectations are from a time standpoint, all of those things. That's something that is specific to each individual and should be a part of a proper education program.
I'm really glad you mentioned that, because especially in these investing classes, it's really to introduce people to these different concepts, but it's really to see if trading investing is for them.
Exactly.
And if people want to learn, they have to start somewhere. They have to find somebody to teach them how the institutions are doing it. So with these options, they're involving stocks.
Yeah, right? Options are something you trade on an underlying asset. Stock market is one thing. You can trade options on the markets in general. You can trade options on individual assets, individual stocks. A person can trade options on futures. You can do that. Options can also be used as protection, as an insurance policy, so to speak, on a portfolio. And people hear all this terminology referring to the options market, like iron condors, iron butterflies, credit spreads, debit spreads.
Sounds pretty fancy.
And they think it's just too complicated for me. Basically, there are only two options. There is a call option and a put option.
Explain what those are.
Yeah, everything else is a combination of those. A call option, just look at that as something that if you buy a call option on something, you are expecting that underlying, whether it's a stock or the market or a futures contract, you're expecting it to go up in value. So basically, you're calling up something. And a put is an option on something that you believe will go down in value. That put option will increase in value. If you buy a put, it increases in value as the underlying goes down. Being able to utilize put options would have been great back in February this year or at the end of 2007 because we went into major market corrections during those time periods. Put options had great returns during those time periods.
Al, before I want to interrupt you there, and I want to talk about this in the next segment, though. But can investors utilize options in retirement accounts?
Absolutely. You want to check with the broker that you're using, but most brokerage firms will allow you to trade options in your retirement accounts.
Yeah, now think about that. In retirement accounts, if people think or investors think the market is going to go down, they can participate in a positive way in a down market. Most people don't know they can do that in retirement accounts.
No, and a lot of the people that come into these free classes, Josh, one of the first questions they ask is that you guys talk about how to participate in a down market. Options is one way of doing it. It's something you can do in a retirement account, in an IRA, self-directed IRA. In 401ks, the employer-sponsored plans, you really don't have a choice to participate profitably in a down market. That's one of the reasons that so many people want to have their own self-directed IRAs where they have choices. You can have options. You can do futures. Inverse ETFs. An ETF is an exchange-traded fund that mimics something like the S&P 500 or technology or financials.
So it trades like a stock then?
It trades like a stock. You can buy and sell it during the day with a symbol like a stock. And there are inverse ETFs that go the opposite direction of the underlying. So again, in your IRAs, it's essentially the same as that shorting concept, which we'll probably have to get into in the next segment.
Yep.
We started talking about it, and then we didn't go into it. But you can't short in an IRA, but you can do the inverse ETFs. You can do put options, which essentially give you the same result as if you had shorted a stock or the stock market.
Yeah, now think about this. Institutions are buying stock at a much lower price, utilizing options, and they're putting their clients into stocks or mutual funds, which require much more capital.
Correct.
So they're utilizing their money wisely, and that's available to the public as well. The public just doesn't know that, and that's why we have these investing classes. Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.